This is TreppWire Week in Review for week ending April 21st, 2023. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. And joining us this week is Orest Mandzy, Managing Editor of CRE Direct. This week, Treasury Secretary Janet Yellen says China-America relations may come at an economic cost. And Republicans introduced a plan to raise the debt ceiling while cutting some of the president's agenda. In economic data, earnings dominated the headlines, with bank earnings a big focus, and other data showing a softening economy. Manufacturing is struggling, and housing remains challenged. Manus, as we close the week, the market isn't really loving what it's seeing.
Certainly not today, a real big down day on Thursday, April 20th. By and large, it's been a mixed bag for the markets and on the economic data front. I will start with the glass half full side of it. The glass half full side of it has been that there were no nasty surprises among the bank earnings in such a way that you felt like another crisis was looming. We knew that bank deposits would be down substantially at some banks, but nobody surprised us with bigger deposit withdrawals than what we were expecting. I think the two worst were Schwab and Western Alliance, which were about 11%. Listeners will recall that we were very concerned that 10% could become 30%. 30% could mean more distressed selling, which could put downward pressure on values and upward pressure on volatility. The fact that we didn't see that is a very, very good sign. When you pair that with the fact that we saw a couple of CMBS deals priced last week, the capital constraints that we were worried about are not nearly as alarming as we thought they might be in mid-March. So good news on that front. And I will introduce a quick detour because I got some heat last week on Twitter and from others saying this was no time to be optimistic. I was wrong to be optimistic. And there's a subtle difference, but there's a difference between being more optimistic and being an optimist. All I was trying to say last week is it wasn't as bad as we thought it could be. So I was more optimistic, but that doesn't mean I think that we are out of the woods. On the negative side, we saw some nasty headlines on valuations dropping, people giving the keys back, big loans going to special servicing. That's why we have Orest here this week, because he can peel back the onion on a lot of what's happening on the ground in some major U.S. cities. And then, of course, today we saw the story from Jack Rogers of Globe Street that said CalPERS was writing down the value of its office portfolio by 20%. So the big pension fund out in California marked down its asset values by $52 billion, which I think is the beginning of what will be a lot of this from the funds, from the private equity guys, from the insurance companies. There will be a lot of reductions of equity values over the next couple of years or sooner. It will be heavily tilted towards office. And this is just an indication of what is to come.
Yeah, I think we're going to see a lot more of that here sooner versus later, CalPERS being the first. And I think to your point, Manus, office will take the headline, but I think it actually gives them some cover on some of the other asset classes and maybe being a little bit more less progressive in terms of mark to market on some of those other assets, because the office sector can be such a big headline number. So kind of been talking about Blackstone for the last several weeks, but they came out this week. Their distributable earnings fell 36% to about 1.2 billion. And they're shed 2% of their value. The steepest drop was reported in the fourth quarter. For the fifth month in a row, so in March, they had limiting of withdrawals from the B-REIT, which we've talked for some time about. So it's really interesting to see. Even Schwartzman characterized the move on the redemption limits as a safety rail to ensure strong outperformance. I'm not so sure that the folks actually wanting to get their money out would agree with that sentiment, but it'll be interesting to see. They've tried to pivot and change the narrative a little bit. Blackstone has been rumored to be talking to some small banks about stepping in to lend alongside them, as more of the banks look to slim down their balance sheets. And so it'll be interesting to see how Blackstone kind of reinvents itself in this current situation, which I'm confident they will find a way to continue to grow their presence in the market, even though they're the world's largest owner of commercial property to date. On the intro, Martha talked a little bit about Secretary Janet Yellen and some of the relations with China. I can tell you, based on the congressional testimony she had during the banking crisis, like, I'm not super excited about her talking about national security. I'm not sure that that's who we want bartering those deals or trying to reassure the public about their moves related to national security. So there's a lot of tensions there. I think you've been asking for the last couple of weeks, man. It's about the next shoe to drop. I think that has some real implications with the relations with China. If those continue to deteriorate, those could have not just national security challenges, but just real impact economically for all of us, because there's a lot of things that we rely on from the U.S. that are produced in China or manufactured there. And so a lot of other stuff this week. Housing data was not great. Home builder sentiment is still negative. So if we look at housing starts, they fell in March. Single family housing construction was actually up 2.7%, but multifamily starts declined 5.9%. So overall, housing starts dropped about 0.8%. Building permits were down fairly significantly, 8.8% to a rate of 1.41 million. And then on existing home sales, they dropped 2.4% in March, which was a 22% decline from a year ago. So again, we're seeing the impacts of this higher interest rate environment felt on the single family side, and home builders have continued to cut home prices to attract buyers. So the National Association of Home Builders said that about 30% of builders dropped their prices in April to try to solicit additional business activity and sales in their markets.
Yeah, speaking about Janet Yellen and national security, it's kind of like me talking about haute cuisine, right? Or haute couture, right? Any of these things where you get out of your lane dramatically, that gets you a little nervous. So let me get Orest involved quickly here. I had an early question for you on this now that we're talking about Brookfield and Blackstone. You've been in this business a while and you've seen past crises. We've talked about on past podcasts that one of the real surprises, at least for me, was that in the retail segment, borrowers were willing to really lean in to fight for their properties, even when maybe the economics weren't there. I think the office story remains to be seen. Do you get any early indications from some of these big guys out there about what level of tenacity they will have for keeping their properties and fighting like the retail REITs and family-owned property owners of malls behaved in the last 5 years?
I think everything is a function of interest rates and the viability of the underlying property, right? Every mortgage has an option to default. And if the prospects of the property aren't good, the borrower will default and give up on the property. And we're seeing that with the best heeled sponsors, Brookfield being one of them. We all spoke briefly about Brookfield DTLA, which is sort of the successor to Rob McGuire's downtown Los Angeles office portfolio. They've defaulted on 3 substantial loans against 3 substantial properties, office properties in downtown LA, and they're probably going to give up on them. They've come out and said they're facing cash constraints, and it's just not worth keeping these buildings simply because they're burning cash keeping them. The 3 buildings are the Gas Company Tower, which has 1.4 million square feet, the E&Y Tower with nearly 1 million square feet, and 777 South Figueroa, or commonly referred to as 777 Tower. Each one of them is about 75% occupied, and this is in a market that has a 22% vacancy rate. And the market, that's a huge vacancy rate. But there are a couple other cities that have massive vacancy rates. Houston, 22.5%, Chicago, 19.2%, Atlanta, 20.5%, Austin, 20.4%. 10% is typically viewed as equilibrium, where both the buyer and the lessee and the lessor are on a plane. At these levels, it's basically the tenants market. We're seeing some slippage in rents or flattening of rents at the same time that operating expenses are climbing. It's not good to own an office property in a major market right now.
Yeah, let me interrupt for just a second. Orest is one of the most modest people I know. He has been breaking stories for a long time, including several recently that he was first to market on office defaults in Los Angeles and other places. So we're going to talk a little bit more about that as the podcast goes on. One more question for you, Lonnie. We were talking about the CEO's remarks for Blackstone. A lot of what I think with this optimism, quasi-optimism that he was expressing is he has so much real estate out there, he has to be an optimist. Otherwise, he's selling more properties at more distressed prices. I looked at this as him talking his book out of necessity. What were your thoughts about his remarks?
Yeah, I agree with you. I think when you're the world's largest player, you move the needle. I mean, everything they say has the potential to be headline risk and move the needle in a negative way. So I don't think you're ever going to hear anybody from Blackstone with any, authority at the company basically coming out and saying, oh, by the way, half our portfolio is in trouble, or the office sector is really going to negatively impact us. And I think they have, reason to be optimistic. I mean, we noted last week they raised $30 billion in the most recent fund. So even with the turmoil and even with the downturn in the market, there's still what seems to be an insatiable appetite for people to give money to Blackstone and have them invest. That's what I was saying. Like, even if the office sector gets written down for them in their portfolio, they're going to pivot. I mean, they're some of the smartest players in the market. They're going to find a way to make money for their investors. So I'm long Blackstone. That overconfidence is necessary when you're a company of that scale. It's similar if you look at David Simon and Simon Property Group. If you ever listen to him on the earnings calls, he's very bullish on the mall market, very bullish on how they position themselves within that space. And it's because they lead the industry in that space. And you kind of have to take that mentality when you're the one that's moving the needle. So Brookfield owns not that much less real estate than Blackstone, but I don't think the markets really view them as equivalent. And Brookfield is usually a little more subdued in their outreach and in making headlines. And so, that might be something for us over the next couple of months to kind of just look at how those two firms continue to play out in the market, because on a relative basis, they both are really big market movers.
Yeah, both have been willing to give back properties very early in the cycle. That's one similarity they have, and we're going to get into more of that.
Orest, I know you are covering a lot in this industry, so walk us through. You mentioned borrowers giving back the keys. What we're seeing on the West Coast and on the East Coast, maybe the Philly area where you're based.
In Philly, we've recently written about 3 major office building loans moving to special servicing. The most recent was the financing against the Wanamaker building. The building's encumbered by $124 million, and $63 million of that is securitized. The building is a stunning piece of architecture, but it's 47% vacant. And that's in a market that's got roughly 20% vacancy rate, and roughly 20% of all the space in downtown Philadelphia comes due or rolls or matures by the end of 2024. It's tough to lease a building in Philly, as it is in just about every other major market.
And we should add that the Eagles lost the Super Bowl this year, but that's just an aside.
Ouch. But you've talked about Philly being maybe a sign of what's happening in other cities as well.
Right. So it's not a very large market. It's got about 48 to 50 million square feet, unlike New York City, which has about 350 million square feet, and Los Angeles, about 250 or so. It's a small to mid-sized market, but it's probably very emblematic of other mid-sized markets in the country, Kansas City, San Antonio, things like that. Or Austin. Austin's got a 20% vacancy rate. So all these markets have large vacancies. A lot of that is driven by tech companies. A lot of it is also driven by hybrid workforces. You don't need as much office space as you used to before.
And you said you've seen equity incentives coming back.
Recently, we've been talking to a lot of folks, and as these loans on office properties come due, what do? Say you've got a loan that has a 4% coupon. You can't extend it because prevailing interest rates are maybe 6.5% to 7%. You're underwater, even if it's paying at the 3.5% rate. So we've heard that some lenders are considering equity kickers, extend the loan for a period, and when you refinance or sell, the borrower and the lender share in the proceeds of any capital event. Last time we really saw that was following the SNL bailout, whenever that was, 30 years ago or something like that. We saw it on a rare occasion in the CMBS market, but the borrower typically had to inject some capital, and the return of capital was based on a capital event, and it was split. But I'm hearing that institutional lenders, be they banks or insurance companies, are more and more willing to consider negotiating some sort of equity kicker in exchange for a maturity extension.
So we had a number of office stories, and it's going to be tough to get through all of them, but let's give that a whirl.
So yes, instead of rattling them all off this week, I'll go through them very slowly and let Lonnie and Orest go through what their thoughts about this. The first one here, this came in early this week through servicer data that came in for April. The $161 million Brookfield office portfolio loan was sent to special servicing. This loan is backed by 12 office properties, most of them in the DC suburbs, more than half of them in the DC suburbs. Year-end 2022, occupancy was just 52%. The portfolio backs a 2018 single borrower deal. The loan does not mature until August, so the special servicing transfer is not maturity related. There are no more contractual extension options for the loan after this month. And at this point, it looks like this could be another one of these big borrowers pulling the plug, right? Hitting the eject button on a property. What do you guys think? What's your hot take on Brookfield and that East Coast portfolio?
In this case, Brookfield had to provide a 6-month notice that they were either going to refinance or not, and they didn't, which kind of indicates that they're having a difficult time lining up takeout financing. And this is in Washington, D.C. suburbs. I don't know if you've been in Washington, D.C. anytime since COVID, but nobody goes into the office down there. That's a challenge.
Yeah, I haven't been there since the McKinley inaugural ball, but I hear that back to office is on the low priority list for most people in the Maryland and Virginia suburbs out there. So I think it's a struggling market. Okay, so I think we score that one as likely to be given back the keys, right? Unless the borrower can coax into a minimal equity contribution and really favorable terms, this thing could be coming back, right? You agree with that, Lonnie?
Yeah, I think at 52% occupancy across the portfolio to almost 2 million square feet, and especially in some of those markets that Orest mentioned in DC and a few others, it'd be really difficult for them for conditions to materially change between now and August when that loan comes up for maturity. So this is one I would definitely mark as having potential to go back. And I think, Orest did a really good job describing some of the other stuff that Brookfield was facing in LA and some other markets. This could be a recurring story across their office portfolio.
Moving on to the next one we saw, this was another real big special servicing transfer. It's called the ADV Portfolio loan. 8 big offices, 5 of them in Georgia, the remainder in Illinois. Again, the portfolio backs a big single asset deal. The initial maturity is in July of 2023. In this case, there are 3 12-month extension options. DSCR 131, occupancy 84%. And I think for me, the takeaway with this is, that first thing was Virginia, Florida, Georgia. The second one here, Illinois and Georgia. We're seeing a pretty good diversity of markets that are being impacted by this transfer to special servicing. Any hot takes on this particular story?
And I'm not too familiar with that loan, but all these extension options typically require the borrower to come up with an interest rate cap. And most of the caps that we've seen have 4.5 or 3.5% strike rates. The lower the rate, the higher the cost. Some of these interest rate caps have become very, very expensive. So even if the portfolio is generating sufficient cash flow today, you buy the cap and the portfolio is underwater.
Yeah, I think this is just another example of the challenges being faced by a lot of these office owners. And, if I were a tenant rep right now, this is probably the first time in the last 10 years where the playing field is on my side, where I have all the leverage. And so I think if there are companies looking to expand their office presence, which there's probably few and far between relative to the people trying to downsize, you could probably get some really favorable terms and some really great locations from an office perspective right now. And so it'll be interesting to see if anyone's able to capitalize on that. But there's a lot of opportunity with some of these buildings where they're sitting at 50 or 60% occupied, where you could probably come take space down, lock in a long-term lease agreement at really favorable terms for the tenant.
I'll throw out 1 or 2 more here. Let me get your take on Chicago. We saw this weekend a lot of unrest among the youth spilling out over from Millennial Park into that downtown area. Two things that jumped out at me are two big properties. One is that Palmer House Hilton, which has been a real problematic loan for a long time. A big hotel down there has been in default for a long time, seemingly cannot get a break. And I think that this unrest in Chicago is just another nail in the coffin for the lenders on that particular property. And then you have, not far from the park, the big Wabash Avenue property, which is primarily occupied by Northern Trust. I have to think that what we saw this weekend has a real negative impact on those 3 or 4 zip codes right around Millennial Park. What do you think, Lonnie?
I think Chicago's got some real problems. I mean, listen, it's one thing for the market to have increasing vacancy across retail and office, and it's one thing for Walmart to say they're shutting stores down. It's a completely different deal when you have, uncontrolled riots and mobs of people destroying property and shooting the place up. I'll tell you, I'm 41 years old and just kind of disgusted at what kids these days are willing to do relative to any other generation I've seen in my lifetime. Chicago has so much to offer. It's a huge economic engine for the US. It has great scenic, historic, there's just a lot of stuff. My brother lives about an hour outside the city. I'm up there frequently. This is really just disheartening for the city. And I'm not sure how it gets fixed. And I think it's going to cause, more challenges for the CRE marketplace. I mean, if you're an investor looking to invest, even with the discounted pricing that you could probably get in Chicago now, which is some of the unrest there, I just got to feel like that market's fallen out of favor. And I don't think until we see some changes in how things are administered there that we're going to see any type of an uptick in that market. I think it's just going to get worse before it gets better. And I'm sad about that because I really love the city. And I wish that it would be more prominent like it has been over the last several decades.
Well, I got to say, I long for the Ferris Bueller type mayhem. That's more my speed. Harmless kids running around the city, joining parades and singing old Beatles songs. That's more my speed. I'll go with you guys for one more. We put out a trading alert this week about the 600 California Street loan going 30 days delinquent. This was that building that was both owned by WeWork, purchased by WeWork, and occupied by WeWork. At this point, I think WeWork is out of the building. They once had 52% of the space. WeWork continues to be kind of that nagging sore on the market. Every city has a couple of WeWorks. In many places, WeWork has terminated the lease, pushing occupancy from 90% down to 40%. In this case, we're talking about a $240 million loan in San Francisco, 360,000 square feet. WeWork had about 180,000 square feet. Just not a happy story.
Yeah, WeWork, it's another challenging piece. I remember when they kind of burst on the scene and there was a lot of discussion around if they were a credit tenant for underwriting purposes, or how did you deal with them relative to other, long-term tenants, because they were going in and signing, 30-year leases or whatever in some of these buildings and taking a huge chunk of the square footage. And we've just kind of see this unravel over the last several years. And this is another example where they actually had ownership interest in the property and unable to keep it going. So they're in a lot of cities, they're in a lot of the major tech hub cities. And it's really, if you've ever been in a WeWork office, the layout of them, the atmosphere in them, actually pretty cool. It's not terrible if you're a freelancer or, a small business needing some space. The offices themselves are really nice, but the market has shown to this point that it's just an unsustainable business model, at least at the prices in which they sign leases for.
Lastly, very quickly, I'll run through these in succession. The sublease story doesn't get any better. Here were some of the stories we covered this week. Carvana will not renew its Tempe lease. This is on Rio Salado Drive in Tempe. Carvana has 135,000 square feet. The property in question backs a lot of CMBS debt spread across several deals. So a disappointing turn there. In Seattle and Kirkland, Tableau Software, which is owned by Salesforce, if I'm not mistaken.
Yes.
They are giving space back for sublease, 200,000 square feet put on the market there, which is just piling on in Seattle. Microsoft, millions of square feet being put on the market, several other firms there as well. In Austin, TikTok has put 125,000 square feet of space out for sublease. So that story just continues. I probably could have rattled off 4 or 5 more of those. There was one big one in Kansas City that came out a few minutes ago, 400,000 square feet. Just a lot of sublease space continuing to grow day after day, and it's something that we're watching very, very carefully.
As an aside, there's nearly 9 million square feet of space available for sublease in San Francisco. Nearly a third of the entire office market in San Francisco is empty or available for sublease.
Well, I do have one more here, sublease story. I wanted to throw this one out there just for yucks. Jostens, remember those guys?
Yes.
They were the guys that made your yearbooks and your class ring. Martha, did you ever wear the class ring on a chain around your neck? Like if you were dating a guy, you had the high school ring around your neck?
No, it's only cool to wear your ring for like 1 year. You wear it that year right after you get it, and then you never wear it again.
Yeah, I hear you. So anyway, they are putting 36,000 square feet of space in Minneapolis out for sublease. And it just makes me think, Julia is our producer today, Julia Selman, in place of Haley Keene this week. Maybe we can go back and find Martha and Orest and Lonnie's yearbooks and put some old yearbook photos out there for our listeners.
Fun. Yes, I have amazing hair, by the way.
Yeah.
I had hair then.
I bet you guys rocked high school. I got to say, you guys, you were in the cool group, I'm sure.
Yeah, cool-ish.
I played guitar in a garage band, because that's what you were supposed to do.
Well, I'd love to get a photo of that. That would go viral in a heartbeat on Twitter for sure.
All right, let's talk about bank earnings. There were a ton of earnings to talk about there. We saw the big banks perform very well. They saw a lot of inflows from deposits coming from regional banks, and obviously the interest rates rising helped parts of their business as well. But then we looked over at what was happening at the regional banks to get a picture not only of their deposits, but some other things as well.
Yeah, Martha. So our research director, Stephen Bushbaum, has put out a really good report looking at loan to deposit ratios and doing some analysis around the regional banks around, what that looks like for them. So loan to deposit ratio is really just the proportion of bank's total loans compared to its total deposits. And it's oftentimes used as an indicator of the bank's risk level. Obviously, higher ratios suggest the bank's taking on more risk and it has less cash reserves on hand to cover unexpected losses. And so in this piece, we actually go through and look at historical trends related to the loan deposit ratio. So without giving away everything here, if you looked at the early 80s to early 90s, the loan to deposit ratio for US banks generally stayed between 76 and 84%. But then as residential real estate lending expanded up until 2008 with the financial crisis, that loan to deposit ratio climbed up to 87 to 97%. And then obviously with the current turmoil, it's had an impact on those deposit ratios. So if you'd like to see a copy of the report, get the information around how we've measured the risk of these banks by asset size, please reach out to us at podcast@trepp.com, and we'll be more than happy to send you a copy of the report, which gives you a deep dive analysis into those loan deposit ratios by banks, by asset size, and then gives you a perspective on the number of banks that have loan to deposit ratios greater than 100%, which we would flag as most at risk.
It was an interesting week for sure on CNBC and Bloomberg. After all these earnings, it's not uncommon to see these CEOs of the banks come out and talk about their numbers and their criticized loans and their deposits and so forth. Obviously, a lot more closely watched this week, but I've never seen, at least not in the last 15 years, as much emphasis on how much office these guys hold and how it's holding up. I think these guys were really coached up. I'm not sure how much these CEOs are in the weeds, granularly looking asset by asset on how their portfolio is doing, but every one of them was really coached up on where the problems are, how bad it's going to be, and it was a real topic of conversation for many over the last couple of days. Certainly something to watch.
Yeah, I think commercial real estate and office were two words used most often in many of the earnings calls. Next week, we're going to be live in front of the ICSC audience in Michigan, and we're going to do a deep dive on retail, talking about all things having to do with the retail sector. And listeners will be able to hear what that sounds like. But there were a couple stories this week that were of note: David's Bridal and Bed Bath & Beyond.
Yes, it's been One of the more positive stories for retail over the last couple of years is that we haven't seen a terrible number of bankruptcies, certainly not like we saw in 2017 to 2020, Party City, Tuesday Morning, or some of the exceptions. This week, David Bridal, second bankruptcy in the last 5 years. Seems like that will lead to either an enormous number of store closings or a complete liquidation. We're not sure at this point, but certainly a nick for anybody that has that exposure as a tenant in their shopping center or mall. The Bed Bath & Beyond story, I guess it's good news and bad news. The bad news is they're not getting any better. The story seems to be continually, slowly spiraling south. The good news is we've known about it for a long time and people have been able to prepare for it. Or I should say landlords have been able to kind of see what's coming months in advance. So not a big surprise there. And I guess we're just grateful that we're not seeing more of this at this point. And hopefully that remains the narrative of the rest of 2023.
Now, I'd say the biggest surprise here is just that we're still talking about them. Like Bed Bath & Beyond is an example. I mean, it's drug out forever. It seems like they reorganize, they come back. But at this point, I mean, the market's shown that they're just not viable. So I'm with you, man. It's overall in the retail sector, it's been really solid news, but a couple of these just kind of thorns in your side that just keep reappearing.
And we should note that Orest and his team have put out the quarterly data review, which is available as of tomorrow morning. So if you want a copy of that, they cover details about what's happened in banking, mortgage REITs, CMBS servicing, and other topics. So it's chock full of really good data. And it's absolutely free for anybody who wants a copy of it. So give us a shout out and we'll be happy to send it to you.
For those that don't know, Commercial Real Estate Direct is a sister company of Trepp. They work independently of us and they write great commercial real estate. I am a big fan of the site, and check out what Orest is breaking all the time. I put him right up there with the gents and women at Cranes and The Real Deal and so forth. Must reads, the business journals as well. Must reads for our market. But it's funny that before he was in the family, I used to refer to Orest as Orest, because he would break stories before we did. And now that he's in the family, I'm very happy when he breaks these stories. But before, he was a competitor, and I was always muttering under my breath about him beating us on a story that was market moving.
You're too kind.
Hey, while I'm throwing nice words at Orest, I got to throw this one out too. His son, who is serving our country, was just in competition to be the #1 ranger in the U.S. Only about 120 rangers are invited to compete in this. It includes running 7 miles with a 60-pound weight vest and then swimming in your uniform across a mile-wide lake. And while his son didn't finish first, I think it's an incredible honor that he was invited to participate at all. And I just can't imagine the amount of conditioning he is in to be able to just do this. So thank you, Orest, to your son for his service, and just a remarkable feat for him.
Well, thank you very much. It was the best ranger competition. It's held every year in the middle of April at Fort Benning. It just boggles the mind what these guys could do.
And some more shout outs. Congratulations to our Education Innovation Challenge winners. It was created in partnership with NYU Stern Business School, and the challenge invited students to create an innovative solution for an issue faced in commercial real estate. First place winner, Jalen Jones from Ole Miss, for his presentation on 3D printing for real estate development and renovation, and honorable mentions to Sophie Muller, a student at St. John's Law, on tangled titles in CRE, and Supasit Vuturaborn for his presentation proposal of community real estate backed tokens. So smart bunch of young people, and congratulations to them for all of their hard work and accomplishments there. And other shout outs, Pearl Mike on Twitter talked about our podcast and gave everyone a shout to listen to it. It's in his staple rotation. Michael G, Aaron B, Manish A, Ann L had some interesting notes on ETF providers. Andrew B, Larissa R, Jake F, Anthony J, and of course, our own Haley Keene, whose birthday is today. So hopefully she's enjoying her time off. And with that, we'll close. Thanks to our producer today, Julia Selman. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send it to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.